So Payoneer stock went up by 50% since we first started talking about it around 4 or 5 months ago in this video, when it was trading at $4.96. Okay, and curiously, at that time we saw how Payoneer stock could reach $7.43, which is where this stock is currently trading. Now, I didn't buy their shares, so I cannot brag about it, right? Instead, I was buying Oracle Resources, which is a copper play about which I've talked in this video. But anyway, now that Payoneer stock has reached the current price levels, the big question is this stock still cheap or is it expensive? Well, that's what we are going to talk about in today's video. First, we will go through Payoneer's second quarter's results, and then we will talk about the stock valuation. Now, before we start this video, just reminding you this is not investment advice, okay? I am just sharing my studies with you. But I've looked at Payoneer's second quarter's results, and here are the highlights, the most important parts for me. So revenue has grown about 15% when compared to 1 year ago, and 5% from the previous quarter. Now, when we look to the geographic distribution of Payoneer's revenue, we see that revenue has been growing at a very strong pace, especially in Latin America, okay, and in Asia Pacific, where it has grown 32% according to my calculations in both regions. In China, revenue has grown 18.5%, while on the other hand, revenue has been dropping in North America. Now, talking about other metrics, adjusted Ebitda went up 30%, as we can see here, while net income went down 29%. And many people would panic about this. But if we pay attention to the income statement, we will see that this is not as bad as it sounds. Quite the contrary, actually. So how could net income go down while adjusted EBITDA went up? We will soon understand why. But the reason why this happened is because, well, if you look at here, operating income, if we pay attention here, we will see that last quarter's operating income was much bigger than what we've seen in the same period last year, right? Actually, according to my calculations, operating income went up by 38.6% when compared to 1 year ago. So again, how could net income go down? This happened because last year we had an extra $14 million gain from change in fair value of warrants, together with an $4.3 million gain from other financial income. So these two items here boosted results by almost $18 million. This quarter, on the other hand, we didn't have such extra gains. So that's how income before taxes came smaller this quarter when compared to 1 year ago, even though operating income increased by 38.6%. Besides, last year, Payoneer has paid only about $6 million on taxes, while last quarter they've paid around $16 million. So that's how net income went down while adjusted EBITDA went up, because last year we had some really good extra boost here, while we didn't pay as much taxes as we did this quarter. But if you pay attention, you will see that the operation is much better now than it was 1 year ago. Now, before we continue to the cash flow part, to the cash flow analysis, if you are enjoying this content, don't forget to hit the like button, and I also invite you to subscribe. Now, speaking of cash flow, I enter this data into Excel to track the cash generation of this company, and here's what I see. So the operating cash flow margin stayed at 17.3%, in line with the previous quarter, but much smaller than 1 year ago, when we almost saw the operating cash flow margin at 30%. Our free cash flow conversion rate, which means how much of the operating cash flow turns into free cash flow, but our free cash flow conversion rate stayed at 65 0.4%, in line with the previous quarter and in line with what we've been seeing in the last 12 months, right? And our free cash flow margin stayed at 11.3%. Now, it's really important for us to pay attention on our trailing 12 months numbers here because they will be important later once we start talking about this company's valuation. So, in the last 12 months, Payoneer has delivered an operating cash flow margin of 20%, together with a free cash flow conversion rate of 65%. So keep this in mind because these numbers will be important. Moreover, Payoneer continued to buy back its own shares, as we can see here. So in the last 6 months, Payoneer has bought around $100 million of their own shares, which is around 5% of the current market cap. Now, to find out how much of their own shares they've bought during the second quarter alone, we have to subtract from this number their Q1 shares buyback. So we have to subtract $51 million. So we can say that during the second quarter, Payoneer has bought around $50 million of their own shares. Additionally, Payoneer has also revised upward their 2024 guidance. So now they're expecting to close this year with around $920 million to $930 million on revenue, while during the first quarter they were saying that they would close 2024 with around $900 million on revenue. Well, let's say they managed to deliver $920 million on revenue in 2024. This would represent a 10.7% growth from last year. Now, before we talk about Payoneer's valuation, they've acquired Squad, a global workforce and payroll management company headquartered in Singapore. The acquisition accelerates Payoneer's strategy to deliver a comprehensive and integrated financial stack for small and medium businesses that operate internationally. Squad was acquired for $61 million in cash, with an additional $20 million of future payments in cash and equity that are contingent upon reaching certain performance and tenure milestones. So these were Payoneer's second quarter highlights. So in summary, revenue keeps growing, business profitability continues to improve, cash flows are okay, and the company keeps buying back a considerable amount of its own shares. Now let's understand, using the discounted cash flow method, whether this stock is a good buy or not. Is it cheap? Is it expensive? Well, it depends on what you think will happen. It depends on your expectations. Currently, Payoneer is being priced in line with its recent performance, in line with what they delivered in the last 12 months. So its stock price reflects the following expectations: a 9% growth rate for the next 8 years, a 20% operating cash flow margin, and a 65% free cash flow conversion rate, which measures how much of the operating cash flow ends up as free cash flow. So if Payoneer manages to continue delivering these numbers for the next decade, for the next 8 years, this means that the current price of its stock can be considered logical and fair using a discount rate of 10%. On the other hand, let's say you believe Payoneer will deliver much better numbers, much better results. So let's say you think that Payoneer will maintain the same operating cash flow margin and the same free cash flow conversion rate, but let's assume they will grow more. Let's assume they will grow at 20% per year for the next 8 years in our projection, right? So if this comes to be the case, this means that the fair price for Payoneer stock should be $13.59. So around here, near its historical peak. And again, this is not investment advice, okay? But I don't think that's impossible at all, especially now that interest rates are starting to drop, right? Which can accelerate the economy and increase the volume of financial transactions all around the world. But if this happens, if Payoneer grows at 20% per year, this would mean that they would get to 2031 with $3.5 billion on revenue, which is not unimaginable at all. The thing is that I don't like to count on optimistic numbers, on optimistic premises. That's why I'm not buying the stock now. I prefer to count on more modest assumptions. This way I have more margin of safety. But I do think their historical highs will eventually be left behind. Besides, though the discounted cash flow method is the safest and most logical one, small cap companies like this are usually evaluated using other methods, such as multiple projections. For example, Payoneer is currently trading at around 3.2 times revenue. And while that's not a ridiculous low multiple, high growth and profitable companies like this, with no debt by the way, are usually traded at much higher multiples. For instance, we've seen this company trading at almost 6 times revenue in the past. So let's project that this company will grow at 15% per year, okay? And that in the future, they will be traded, this stock will be traded at 4 times revenue, okay? This would mean that in the future, the fair price for the stock should be $27.24. Now, if we discount that back to the present, using a 10% discount rate, this would mean that the fair price for the stock today should be $12.71. So near its historical peak again. Here, $12.71. So is Payoneer stock cheap or is it expensive? Well, it depends on what you think will happen. Personally, I would rather stay out and buy other things such as Illumin Holdings and Oracle Resources. As I've said, at the current price, I feel like I don't have much margin of safety and that I have to count on too much optimistic premises to logically see some upside. Now, this doesn't mean I don't find Payoneer a good company or that I don't believe its stock won't go higher. Quite the contrary, actually. Anyway, I will leave this Excel sheet on this video description so you can play with the numbers and decide for yourself if Payoneer is a good buy or not at the current levels. You just have to download this document to be able to edit it. Well, that's it for today. See you next time.